So this week, we bought Bentley Systems, ticker BSY. And disclosure first, as always, we own it. Bought this week with our own money, so nothing here is neutral. This one has a story we really like, and it starts with how we found it. Because we didn't start with the stock. We started with our sector page, which lines every sector up against its own valuation history. And technology as a whole, stretched. 77th percentile against its own past. Not obviously a place to go shopping. But here's the part most people skip. A sector isn't one thing. Click into technology and it breaks into industries, each against its own history. And look at that. While the sector reads stretched, application software sits at the 20th percentile, below its own average. That's the corner we went hunting in, and that's where Bentley was. So what is it? Bentley makes the software that engineers use to design and manage infrastructure. Roads, bridges, rail, water systems, power grids. When a government or a builder plans something that has to stand for 50 years, this is the kind of software it gets drawn and maintained in. And the business model is the part we like most. 92% of revenue is subscriptions. Recurring revenue is $1.5 billion a year, growing about 12%. And existing customers, on average, pay 9% more each year than they did the year before. Engineers don't casually switch the software their bridges live in. The health row backs most of this up, and honestly, we haven't shown one like it before. The operational score is 9 out of 9. We track hundreds of these, and a perfect score is genuinely rare. Bankruptcy risk safe, earnings quality clean. Read the 2 amber tiles too. It carries some debt, and near-term resources against this year's bills are tight. And through all of that, it keeps about 35 cents of free cash from every dollar of sales, rising. Put together, our buy zone reads strong buy against Bentley's own history. It's down about half from its 2021 high, and it's just climbed back to its 200-day average. But read the flags too. The verdict is working from a short history, because this company only listed in 2020, and the long-term chart is a laggard. The page doesn't hide either. And recently, buying has picked up. Our trend reads plus 31, buying building, with 13 of the last 20 days closing strong. One honest caveat. That's happening on lighter volume than the weeks before, so it's early, not a stampede. Now the risks, out loud. This is not a bargain price. You're paying about $39 for every dollar a year of profit, and similar software companies go for about $31. On next year's expected earnings, it's $26, which is friendlier, but nobody is giving this away. It's also beaten expectations in 6 of the last 8 quarters, not 8 of 8. Quality is real, so is the price tag. So that's the bet. The world doesn't stop building roads and grids, and the software they're designed in compounds quietly on subscriptions at a 9 out of 9 operational score. If that keeps up, the full price takes care of itself. If growth stalls, we overpaid and we're wrong. We own it as of this week. That's what we did and why. Visit us at smartcharts.co, where we explain the stock market in plain English for people who were never given the manual. Nothing here is financial advice.